Before we get totally started with today's video, I want to talk about a very common problem that I hear from traders, which is, are you ever stopped out by a trade just to watch that trade go in the initial direction you thought it was going to? Take a look at the chart with me. Look at this here. We have a push down below our EMA, a little pullback, a doji candle. We're looking for short trades. Let's see what happens. Boom, another doji and a close below. Now we go short. Where do we put our stop loss? Because we went short there, our stop loss needs to be right above our swing high, right? That's what everyone says. So we put a stop loss above the swing high. Let's see what the market does now. And just like that, you're stopped out on a potential good trade. Just to watch the market do what? Let's see what the market does. Here's the really devastating part. Here's our trade, right? If we keep looking, this trade would have eventually came down and hit exactly where you thought the market was going to go. But instead, you were stopped out by just a little bit before the market went in the direction you thought it was going to. I have questions about this all the time from traders, and this is something I initially struggled with at the beginning of my trading career. I had devastating losses due to having my stop loss too close, not paying attention to market volatility, and barely being stopped out before the market went exactly where I thought it was going to go. Now, what if I told you that the indicator I'm going to share with you in this video and show you how to use would have made this trade go a little more like this? Take a look. Here's the difference. You see, we have the same exact entry, the same exact trade setup, except on this chart, we now have the way a rookie trader would place a stop loss against the way professional traders place stop losses using the indicator I'm going to show you how to use in this video right here. Let's take a look at what happens with the market now based on our new stops and targets. As you can see, using the rookie way of placing stops, we have a stopped out trade right there. You're losing money. Using the professional way, we have a little more room because we placed a stop based on the volatility of the market using the indicator I'm going to share with you in this video and show you how to use. Because of that, we were not stopped out of the trade, and the market went on to, in fact, hit our target at a 1.5 to 1 risk reward, turning this from a losing trade into a winning trade. So as I said before, I have been devastated by losses like this, especially in the beginning of my trading career. And although there's no way to not be stopped out ever, of course you'll have winning and losing trades throughout your career, there is a way to minimize the amount of times you get stopped out by a whipsaw in the market or because you're having your stop losses too close to structure, and that could be causing stop hunters to hit them as well. I'm going to show you how to avoid both of those using this indicator I'm going to show you in this video. Also, towards the end of the video, I'm going to show you a full strategy and different ways to use this indicator, incorporate it into your trading to give yourself a better edge over the market. This is by far my favorite indicator and the only indicator I use every single time I place a trade. So I'll be right back to share with you what it is, how it works, and how you can use it to improve your trading as well. So what is this mysterious indicator that can help you avoid barely being stopped out before the market heads to your initial targets? It is called the ATR, or Average True Range Indicator, and I use it every single time I place a trade in order to help me with my stop loss placement. And we're going to discuss what the indicator is, why you need it, how to use it to place stop losses, and a full strategy based around this indicator in just a second. But first, I want to show you the chart on the screen. As you can see, this chart on the screen has vertical red and green lines. They represent wins and losses based on the strategy I'm going to teach you at the end of this video. This strategy, since 2018 on the dollar Canada, produced 31 opportunities. 11 of those opportunities were losing trades. 20 of those opportunities were winning trades, meaning that this strategy since 2018 until today's date on the dollar Canada produced a 65% winning percentage. So make sure to stick around until the end of the video to learn this exact strategy that will help you when trading around false breakouts. But right now, let's dive into what is the ATR indicator and get started with the video. ATR stands for Average True Range, and what this indicator does is gives you the average of the last 14 candles printed on a specific time frame and currency pair. It has an input, so you can change that 14 to whatever number you want. If you want the average of the last 10 candles, you can do that. If you want the average of the last 5 candles, it does not matter. Personally, I keep the inputs exactly as they are stock, and I look at the average of the last 14 candles on a specific currency pair and time frame. Now that you know a little bit about what the indicator is, why do we need it? Well, because each currency pair has a different amount that it's going to move per candle. For instance, here on the pound New Zealand, we currently have an ATR. If you look at the top left of my screen, I'll go ahead and circle it for you. This is 122 pips. So the pound New Zealand right now has an ATR, or an average range, of 122 pips. That means the last 14 candles on, right now we're on the 4-hour chart, on this 4-hour chart, average to be 122 pips. Let's move on to a different currency pair that doesn't move quite as much, such as the Canada Swiss. The Canada Swiss has an average right now, the past 14 candles only moved 34 pips. So the reason we need to know the average of the last 14 candles, or the amount of volatility this market's moving, is because if we're going to place a trade on the Canada Swiss, let's say we do this right now. We place a trade on the Canada Swiss, and it looks something like this. Let's just say we go short, for example's sake, and you want to say, let's say you're a beginning trader, and you use a 10 pip above the entry candle as every single time you place a trade as your stop loss. So you would say, okay, here's my 10 pips, 28, that would be 38. And I'd be looking, let's say you're just looking for a 1-to-1 to keep it simple. Do you think that this 10 pip stop loss is going to work just as well on the pound New Zealand as it does here on the Canada Swiss? If the Canada Swiss is only moving at an average of 35 pips per candle, and the pound New Zealand is moving at 122 pips every time a candle's printed, do you think you're going to be stopped out a little more often here on the pound New Zealand? Yes, you are. And that's why we need to know the average true range of every single currency pair we're trading. Depending on the currency pair you're trading, your stop loss may need to be larger or smaller. And in a very similar way, it depends on the time frame as well. If you have a 10 pip stop loss on the 15-minute time frame, do you think that same 10 pip stop loss is going to work on the daily time frame, when the daily chart has an average of 378 pips per candle, while the 15-minute only has an average of 26 pips per candle? And you can see that again by looking right up here. Of course, the answer is no. You need to know that average. You have to know that, and that's what I use every single time I place a stop loss, and that's the reason I use the ATR indicator in order to place my stop losses, is because every currency pair is going to have a different amount that it moves per candle. Every time frame has a slightly different amount it moves per candle, so you need to incorporate that into your stop loss in order to avoid those devastating losses where you barely get your stop loss hit. Again, there's no way to always avoid it, but this will help to minimize the amount of times your stop loss is hit barely, and then the market goes in your favor the way that you originally planned the trade to go. Now that you know what the ATR is and why we need it, let's break down how we can actually use this to place appropriate stop losses instead of placing a stop loss like a rookie trader. Let's jump into that right now. All right, so now let's talk about how you can actually use the ATR indicator in order to help you place correct stop losses. Another reason you need an indicator that measures volatility like the ATR is because of different variations of volatility in the market as a whole. For instance, like what's been happening recently with the market volatility we've seen as of late, do you think little 10 pip stop losses would have kept you from being stopped out? You would have been torn up by these markets that have been happening recently if you would have not been using some type of volatility indicator for your stop losses. And you may have been eaten up, and this is how you can avoid that next time. It's by using an indicator like the ATR, and this is how you use an indicator like that in order to keep from being stopped out prematurely on trades during volatile markets or different currency pairs or different time frames. What we're going to look at now is how to actually plot the ATR indicator on your chart. I'm going to talk to you as if you're using TradingView because it's the platform that I use. So in TradingView, you go to indicators is one of the top ones, but if you want to make it easy, all you have to do is type in average true range. It is at the top right here. Click it. It will plot the average true range indicator on your chart. Now, if we just scroll all the way over and hover over nothing out here to the far right edge of the screen, then you will see right here we have a number. That number is 70 at the moment. That means that currently on this market, the ATR is 70. You can also see that if you look over here on the right hand side of the screen, right here at the side of the indicator. I personally choose to look over here, but it's completely up to you. That number, again, is current ATR. The current average true range of the dollar Canada on the 4-hour chart is 70 pips. So that means that out of the last 14 candles printed, 70 pips is the average. Now, if you want to use this for back testing, what you have to do is hover over whatever specific candle you want to look at the ATR for. So for instance, if I hover over this larger green candle that you can see my crosshairs over right now, you can see that that average true range is 22 pips. So if I hover over a candle, the previous candle is 18.5 pips. The previous candle before that is 18.6 pips. Hovering over a candle is how you use this indicator in backtesting. But in order to use it to place your stop loss, the way that I personally use this indicator, placing a stop loss, is if I had an entry right here, let's say on this candle that I'm circling now. Bad circle, let's do that again, right here. This like hammer lookalike candle. If I had an entry there, instead of saying, I got my entry, now I'm gonna use a, let's say I'm a rookie trader. The difference being that I'm not, and I would not do this, but a rookie trader may say, okay, I'm gonna place a stop loss 10 pips below this low. So that would be 82, 83 pips. And that ends up being stopped out. Let's say we have a 2-to-1 risk reward. Again, just keeping it simple. That would end up being stopped out, right? The difference would be I would hover over my entry candle in order to actually use the ATR indicator to place a stop loss. I would hover over my entry candle, showing me that the dollar Canada on this candle has an ATR of 80 pips. With that being the case, I wouldn't be placing a 10 pip stop loss below my entry candle or below this swing low, which is where my stop loss is going right now. That means if I had an 80 pip stop loss, I would use that value of 80 pips under my swing low or my entry candle, depending on which one was lower. The previous swing low, though, at the entry being right here, is this entry candle. So I would put a stop loss at 80 pips below that candle. That means that we would have a stop loss of 153 pips. Yes, you have a larger stop loss, but that, again, is the point. You want to stay out of being whipsawed out of the market because you have this tiny little stop loss. So with that being the case, we now have a stop loss that looks like that, and a 2-to-1 risk reward would have been hit because we used the stop loss correctly using the ATR indicator. So what we would be looking for, yet again, is whatever your entry may be. Okay, so let's say we have an entry on this big close above candle here. We would look at this as our entry. If whatever entry you're using is totally fine. I'm just trying to show you how to place a stop loss using the ATR. You would then want to hover over that candle. When you're hovering over that candle, look at the top left side of the screen. I'll circle it for you. The ATR is 67 right now. So you would put a 67 pip stop loss below the previous swing low. That's exactly how I use the ATR indicator in order to place better stop losses that are less likely to be hit by highly volatile markets or by different currency pairs that have higher averages in terms of the candles they print, or in different time frames. For instance, the 15 versus the daily. This is how I use it. So the trade setup here, if I have my profit taking tool, would look like this. We talked about our big green candle as our entry. The ATR of that candle is 68 pips. 186 plus 68 is 254. So we would have a 254 pip stop loss. And that's how you would set your stop. Again, you set your targets accordingly. It doesn't 2-to-1 risk reward, whatever kind of target you want. This is just me showing you how to use an ATR indicator in order to place stop losses that keep you out of these whipsaws and keep you from being stop hunted by placing your stop loss a little further away or even a little closer at times, depending on the volatility of a certain market at a certain time, depending on the volatility of all markets at that time, and on a certain time frame. You do so by looking at the average range of your entry candle, using that amount, that average true range amount, below the swing low on a buy trade or above the swing high on a sell trade in order to maximize your ability to possibly win that trade instead of being stopped out for a loss. So that's how you use the ATR to place an appropriate stop loss. That's how you use the ATR to place a stop loss like a professional trader instead of a rookie. What I'm gonna do right now is show you a strategy, an actual entry technique using the ATR indicator to help you take advantage of false breakouts and to give you a strategy that proved to have an edge over the dollar Canada from 2018 to now. So let's briefly go over that strategy right now. All right, let's jump right into the strategy. This is going to be a very brief explanation of the strategy. I'm going to do a full tutorial on this strategy later on this week, but right now, let's talk about it. This strategy is meant to capture false breakouts. What is a false breakout? False breakout looks something like this. If we look right here, we have a swing low. We have the market pushing below that swing low, signaling to breakout traders, yo, it's time to go short. Let's go. Let's push this market down. But the false part in this comes true, and instead of pushing down, the market just immediately reverses. This is exactly what we're trying to capture with this strategy. In order to understand the strategy, you will need to know what a swing high is and a swing low, because this is what we're looking for, is breakouts of swing highs and lows. For me, just to give you a very brief explanation of swing highs and lows for this example, a swing high is a high that was preceded by at least 2 lower highs and followed by at least 2 lower highs. That would be a swing high. A swing low would need to be preceded by 2 higher lows and have at least 2 higher lows after it. So that would be a swing low. That's what we're looking for initially with this strategy. After we find a swing high and a swing low, we are placing a horizontal line at that swing high or low, like we have right here, and we are waiting on a break below that level. In this case, it would be a break above for a swing high. In the case that we have on the screen in front of us, though, it would be a break of this swing low. We get that break right here with our big red candle. This is where the ATR comes into play. On this break, we have our conditions down. We have the fact that we're looking for a break below a swing low for a bearish trade. We know what a swing low is. It's a low preceded by 2 higher lows and followed by 2 higher lows. So we're waiting on a breakout of a level like that. We have this breakout candle, the candle from high down to low, must be larger than the ATR of the breakout candle itself. So it must be larger than the ATR of this candle that broke out. So our breakout candle has an ATR of 79 pips. What we would need to do is measure from the high to the low of this breakout candle and see if it is more than 79 pips. It is 102 pips. I need this candle to be between 1 ATR and 2 ATR. In this case, the ATR of our candle is roughly 80 pips, so I would need this candle to be between 80 and 160 pips. If it's more than 160, does not count. If it's lower than 80, it does not count. If it's between the two, if it's between 1 and 2 ATR, then I use this candle as an entry for a false breakout situation. What does that mean? That means at the close of this candle, if it meets all of those requirements, I would have an entry at the close of this candle because it is a breakout candle from a previous swing low that is between 1 and 2 ATR. It's not lower than 1 ATR and it's not above 2 ATR. Therefore, I have my entry. Let's discuss stops and targets really quickly. Stops for me are going to be 1 ATR below the low of my entry candle on a buy trade. This would be a buy trade. So my stop is going to go 79 pips below the low of that entry candle. Let's do a trade setup with an actual position tool. Here we have our long trade, our entry on that red candle. I don't know why these things always turn out so huge. I guess I'm zoomed in pretty far. So we have our entry set. We would now have a stop loss placed 1 ATR below the swing low. So we have 11 pips on that swing low at 79 pips. That means that we would have a stop loss of 90 pips. So let's put our stop loss at 90 pips, following our rules. And for targets on the dollar Canada, what I just showed you at the beginning of this video, I just used a 1-to-1 target. That's what produced since 2018, right at a 65% winning percentage, was having a 1-to-1 target. But as you can see, sometimes these false breakouts can provide a massive risk to reward ratio. So that's the power of this strategy, and that's a brief version of how to actually do it. Let's take a look at a couple of the trades over on the dollar Canada back test, and then I'll let you guys go. But first off, let's take a look at a couple of those so you can get a better idea of this strategy to make sure you completely understand it. Main goal here being that you are capable of actually testing this strategy yourself before I come out with the next video that explains it completely. So hopefully this will give you an idea of exactly what you need to be testing for. Here we have our swing low, looking left, right here. We have a breakout candle of that swing low right here. What do we need to check for next? Next, we need to know, is this breakout candle between 1 and 2 ATR of this candle? This candle has an ATR of 91 pips. So we need to measure this candle from high to low. From high to low on our entry candle, we have a 110 pip candle. That means this candle is between 1 and 2 ATR because it needs to be more than 90 and less than 180. So therefore, we would be buying this breakout candle, looking at it as a possible false breakout. That would look something like this, the buy trade being at the close of that breakout candle, like so. The ATR of that candle is 91 pips, so we would have 91 plus 31, which would be a 122 pip stop loss. That did not get stopped out. Target, again, in this case was a 1-to-1, but as you can see, potential for much greater targets. I haven't finished all the testing, but this is the strategy I'm currently working on using this ATR indicator as a possible indication of a false breakout. Go back and study those rules so that you can go ahead and back test this yourself. Also, if you're interested in some more Forex training, more advanced strategies, sort of like this, but even more advanced and even more capable strategies, then we do have a full training program called the EAP training program. In that program, you'll receive all the strategies that I personally use on a daily basis. You'll receive 3 to 5 of the actual trades I'm placing every single week, and you'll also get priority email, which means you can ask me any questions you have about Forex and I'll be there to help you about the course, about the strategies. In this program, it is a mentorship program, so I'm there for you every step of the way. We currently have a couple of places available due to some recent graduates, which I will show you now, some of their comments and testimonials while you're reading through those. Also, go ahead and make sure you're subscribed here to the trading channel. Make sure you click that like button for me to help out with the YouTube algorithm. I'm going to put a video somewhere on the screen. You'll see it beside my face that I think would also be helpful to you on your trading journey. Make sure you follow in all of your rules in your trading plan. Make sure you're not risking too much in times like these. Put good use to your newly learned skill of understanding this ATR indicator in order to avoid being stopped out just by a little bit before hitting what could be massive targets. I hope this has been helpful, and I will talk to you in the next video. See you soon.